Right now, the largest asset manager on Earth is quietly shifting capital away from the United States, and almost nobody is talking about it. This isn't politics. This isn't hype. When BlackRock moves, markets feel it months later. And what they're doing right now should make every investor stop and listen. BlackRock doesn't panic, it doesn't speculate, it doesn't chase headlines. When a firm managing over $10 trillion changes direction, it's never emotional and it's never random. It's calculated, slow, and based on signals most people don't see until it's too late. That's why the question matters so much. Why would the most powerful money manager in the world be reducing exposure to the very country that built its dominance? For decades, the United States was the default destination for global capital. Safe, liquid, predictable, strong institutions, deep markets. You didn't need to love America to invest in it. You just needed to understand math. Growth, stability, and the rule of law made us assets the cleanest shirt in a dirty laundry pile. But something has shifted, and BlackRock is signaling it without ever saying the words out loud. Low, K, at where capital is flowing. BlackRock has been increasing exposure to energy infrastructure outside the US, emerging market debt, private credit in Asia, and real assets tied to commodities rather than paper growth stories. At the same time, they're dialing back enthusiasm for long-duration USBR. Bonds and overvalued equity sectors that depend on cheap money never returning. That's not a vote of confidence. That's a hedge against systemic stress. The first crack is debt. America's debt problem isn't new, but the scale and the speed have changed the game. Trillions are added with almost no political resistance. Interest costs are now one of the largest line items in the federal budget. That matters because it turns debt from a future problem into a present one. When servicing the debt competes with defense, healthcare, and social programs, something breaks. BlackRock understands that bond math always wins. You can argue ideology forever, but yields don't care. His second crack is monetary credibility. The dollar still dominates, but dominance is not the same as trust. Repeated emergency interventions, balance sheet expansion, and policy reversals have trained markets to expect instability. Inflation was called temporary, then it wasn't. Rates were supposed to stay low, then they exploded higher. Forward guidance stopped guiding anyone. For long-term capital allocators, uncertainty is risk, and risk demands diversification away from a single system. Then there's geopolitics. Capital hates friction. Sanctions, trade wars, asset freezes, and financial weaponization may achieve short-term political goals, but they permanently change investor behavior. When reserves can be frozen and contracts can be rewritten overnight, global capital starts asking uncomfortable questions. Not because America is weak, but because precedent matters. BlackRock's clients include sovereign funds, pensions, and institutions that think in decades, not quarters. This isn't about BlackRock abandoning the US. It's about them no longer treating it as the only pillar holding up the global system. That distinction matters. When diversification replaces concentration, it signals a shift in perceived risk. And when $10 trillion starts repositioning, even slowly, the ripple effects are enormous. The most important part is this. BlackRock doesn't wait for crises to be obvious. They move when the incentives change. And right now, the incentives inside the US financial system are flashing yellow. Not red, but yellow is when smart money quietly leaves the intersection. They're not running. They're repositioning because the old assumptions no longer hold the way they used to, because the risk-reward equation that defined America for 40 years is being rewritten in real time. Low rates are gone. Cheap leverage is gone. The idea that growth can outrun deficits forever is gone. What replaces it is something much more fragile, a system that depends on confidence staying intact. And confidence, once cracked, never comes back the same. BlackRock sees this through market structure. U.S. equities are no longer cheap relative to global alternatives, especially when adjusted for volatility and policy risk. Corporate margins are under pressure from higher wages, financing costs, and slower demand. Buybacks are slowing, earnings growth is being supported more by accounting adjustments than real expansion. That doesn't mean a crash is imminent, it means upside is capped while downside risk is asymmetric. At the same time, U.S. Treasuries no longer play the role they once did. For years, they were the ultimate hedge. Stocks fell, bonds rose. That relationship is broken. Inflation risk turned bonds into a source of volatility instead of protection. When the supposed risk-free asset starts behaving like a speculative instrument, portfolio construction changes completely. BlackRock has been very clear about this in its positioning. Even if the headlines don't spell it out, zoom out. The world is fragmenting into blocks. Supply chains are regionalizing. Energy security matters again. Strategic metals matter again. Countries want control over resources, not just financial claims. That favors real assets, infrastructure, and commodities over financial engineering. The US still has strengths here, but it also has political gridlock that makes long-term planning difficult. When policies swing every election cycle, capital looks elsewhere for stability. Another factor people underestimate is demographics. The US is aging, not as fast as Europe or Japan, but fast enough to change savings and spending patterns. An aging population sells assets. It doesn't accumulate them at the same rate. Pension obligations grow. Healthcare costs grow, bar. Productivity growth struggles to keep up. These are slow-moving forces, but BlackRock specializes in slow-moving forces. They build portfolios around them, ND. Then there's the private side of the market, where BlackRock has been extremely aggressive. Private credit, private infrastructure, private equity tied to tangible cash flows. Why? Because public markets are crowded and fragile. Everyone owns the same stocks. Everyone is chasing the same themes. When liquidity dries up, exits disappear. Private markets offer control, pricing power, and insulation from daily volatility. Increasingly, those opportunities are outside the USBRN. Any of this means America's collapsing. That's the lazy take. It means America is normalizing. It's becoming one option among many instead of the unquestioned center of gravity. For global capital, that's a massive psychological shift. And psychology drives flows long before fundamentals show up in the data. Dr. RE is the uncomfortable truth. Retail investors are trained to look for certainty. Institutions look for probabilities. BlackRock isn't making a moral judgment, it's making a statistical one. Higher deficits, higher rates, higher political risk, and lower marginal returns change the math. When the math changes, allocation changes. Quietly, methodically, without panic. The warning isn't that BlackRock is pulling money out. The warning is that they don't need to announce it. They know the crowd will notice only after prices adjust, after volatile ID spikes, after the narrative changes. By then, the positioning is already done. And that's why this matters. Because the signal isn't in what they say, it's in what they're doing, and where they were doing it, and how early they're doing it before the rest of the market fully understands what's happening, and what that means for investors who assume the past will simply repeat itself without resistance, without consequence, without cost, and without warning when the underlying structure finally gives way. History shows this pattern over and over. Empires don't fall in a single moment. Capital leaves first, quietly, rationally, long before headlines catch up. And that's the lens you have to use to understand what BlackRock is doing right now. Because when confidence erodes, it doesn't collapse all at once. It leaks. Small reallocations, slightly lower weightings, more hedges, more non-correlated assets. Over time, those small decisions compound into massive flows. And flows, not opinions, move markets. If you're waiting for a dramatic announcement or a public confession, you'll miss the point entirely. Institutions never ring the bell at the top. They just stop buying brie. Here's also a deeper layer most people miss. The US financial system has become heavily dependent on asset inflation to maintain stability. Rising markets support pensions, tax revenues, consumer confidence, and political promises. But asset inflation requires either growth or liquidity. Growth is slowing. LBR, bar. Liquidity is constrained by inflation and debt servicing. That leaves policymakers boxed in. Any move has consequences. Raise rates and stress the system. Cut rates and risk currency credibility. Do nothing and let pressure build. From a capital allocator's perspective, that's not a comfortable environment. BlackRock's shift is a signal that optionality matters more than loyalty. Capital today is more mobile than ever. It doesn't need to sit in one country and hope things work out. It can move across borders, currencies, and asset classes with a few keystrokes. The US used to be the safest place to park that mobility. Now it's one of several places competing for it. That's a subtle but profound change. Bar. Or individual investors, this isn't about copying BlackRock trade for trade. You can't. Their tools and time horizons are different, but you can learn how they think. They're asking where returns will be real, not nominal. Where cash flows are durable, not dependent on refinancing. Where political risk is priced in, not ignored. Where assets are scarce, not endlessly reproducible. Those questions matter more now than ever. BRT. Real danger is complacency, assuming the dollar will always dominate, assuming Treasuries will always protect you, assuming US equities will always outperform simply because they have in the past. Those assumptions worked in a specific era. That era was defined by falling rates, expanding globalization, and rising trust in institutions. We are no longer in that era. The transition doesn't have to be catastrophic to be painful for the unprepared. So when you hear that BlackRock is reallocating, don't hear fear. Hear discipline. Hear adaptation. Hear a warning written in capital flows instead of headlines. The kind of warning only visible if you know where to look. Because when $10 trillion starts positioning for a different future, it's not predicting collapse. It's acknowledging change. Bar. ND change is the one force markets never forgive you for ignoring. The story here isn't that America is finished. It's that the margin for error is shrinking. The easy years are over. The free lunches are gone. The world is demanding higher returns for higher risk. BlackRock sees that, acts on it, and moves before the crowd. BRT. The real question isn't why BlackRock is pulling money out of America. The real question is why so many people still assume it has no reason to bar.